Hello, welcome to this webinar. My name is Javnyuy Joybert. I am a doctoral candidate in business administration with specialization in entrepreneurship and investment with Kesmont International University, America. This webinar is part of my doctoral program with KIU, where I do quick videos or important videos to talk about key things in the course that I am taking. And today I'll be talking about corporate finance and financial management. And many of the examples that I'll give throughout this webinar session will focus on the African market and sometimes just in Cameroon. And again, as I said, this is part of my doctoral program with Kesmont International University. So let's start with the foundation, which is what is financial management? Financial management is one of the most important aspects in business. And in order to start up a business or even run a successful business, business executives, business founders will need to have excellent knowledge and practice in financial management. At some point, they may not be the ones who have this excellent knowledge in financial management. They can recruit what you can call chief finance officers, accountants, or finance officers for their businesses. And financial management, therefore, refers to the strategic planning, organizing, directing, and controlling of financial undertakings in a business or an institution. And it also includes applying management principles to the financial assets of the business, while also playing an important part in the fiscal management of the whole process. And the objectives of financial management could include maintaining enough supply of funds for the organization. This is a very important piece because if the right amount of financial resources are not available, important things like manufacturing or product or paying staff or buying logistical things may not be taken care of. This can affect the running of the institution. Number two, ensuring shareholders of the organization get good returns on their investment. Yes, because it's not good for a business not to bring in the right ROI for the shareholders. Optimum and efficient utilization of funds, creating real and safe investment opportunities to invest the money that have been acquired. And there are three types of financial management per se, and we look at these three main areas. Number one is investment appraisal, which is the procedure by which the viability of work is assessed. This is one of the primary inputs in as far as any business case is concerned. Number two is funding, which is concerned with securing investments required to complete the work or to get the business running or to ensure support for the cash flow. Number three is budgeting and cost control estimates, which try to predict cash flow and then apply this cash in order to monitor the cash flow or how money is moving in the business. Of course, this is very important. And of course, we cannot talk about finance and financial management without looking at the three basic rules of money. Money, number one, your income should always exceed your expenses. So if you're developing a profit and loss account, every good business person is always praying for that at the end, total income should exceed expenses. Number two, always make a plan for your money. When you have acquired money through capital structure per se, you need to make a plan for it. This is where budgeting comes in. Multiply your money. Be able to put money into sales, into investments that can bring in more money into the business. And one important aspect of financial management or finance is the people. And the head honcho here is the finance manager. And the finance manager has three key functions. Number one is financial forecasting and planning, where a financial manager has to estimate the financial needs of a business. Number two is acquisition of funds. Where are we going to get money from? We need to acquire the money. It's a finance manager's job to recommend how the business will get money. Number three is investment of funds. The funds should be used in the best possible way that can help the business to be profitable. And of course, finance managers face the finance managers get to face a couple of challenges. Top three could be regulatory compliance. If it's a country whereby maybe the Ministry of Finance or the agency in place keep changing regulatory things, it can be a challenge for the finance manager. Poor decision making can be a challenge. It takes a lot to make a good finance decision. The next is inadequate staff. If the finance manager has poor staff under him, it can be a huge challenge for him to be very successful. So let's look at the two types of finance. Number one is debt finance. Debt finance, and another one is equity financing. So debt finance, this is money borrowed from external lenders such as bank or debentures could be here. Equity finance is where the founder could invest his or her own money or fund some stakeholders, shareholders, or exchange for partial ownership of the business. Or you give me $1 million and I give you 10% of the company. That is equity finance. Now, there are 5 key sources of finance available to a business. Number one could be personal savings of the main founder, of debt financing like loans, angel investors, venture capitalists. These venture capitalists don't invest really in startup, they invest in businesses that are already growing, and they're always targeting for what would they benefit when the business go public or when they sell the business. And the next one is, of course, shareholders. You can ask people to buy shares in the business. And an important part of financial management is, of course, financial decisions. And there are basic financial decisions that the finance officer get to make or the business get to make. Number one is capital budgeting or long-term investment decision. That is the application of funds. How are we going to use this money? Number two is capital structuring or financing decision. How are we going to get this money? Procurement of funds. Number three is dividend decision. That is the distribution of funds after maybe a business year, a financial year. How will the money be distributed to the various investors? Number four is working capital management decision in order to accomplish the goal of the firm and maximize shareholders' wealth. And there are some factors that can affect financial management of an organization. Number one is government regulations. Number two is the state of the economy. If there's high inflation or low inflation, or the economy is not well run, well managed by the government in place, it can affect the financial nature of the organization. The cost of acquiring funds can affect this. Next is the skills of the finance department. If they have poor skills, it can affect the financial management of the organization. If they have high good skills, it can positively affect the financial management of the organization. Now, there are a couple of factors that can affect financial decision making. Number one is nature of the business. Number two is the size of the business. Number three is the expected returns of the money invested. Number four is the cost and the risks involved in running that business. Number five is the asset structure of that business. For example, a business that their asset is just lands, cars, is different from a business that their asset includes ships and airplanes and aircraft, all of that. The structure of the ownership, the same with to make decisions in proprietor, partnership, limited liability company, and public limited companies are not the same. Next is expectations of the investor. So these factors affect financial decision of the business. And there are 4 key factors that can affect the financial performance of the business. Number one is the growth rate of the business. Number two is the fixed asset investment. What kind of assets, fixed asset is the business buying? Number three is the capital structure. Number four is the business risks. These 4 key things can affect the financial performance of the business. And financial plan is an important piece in financial management. And the financial plan for a business is an overview of a business financial situation and a forward-looking projection for the growth of the business. And there are 6 key components of financial planning. Number one is sales forecasting. You cannot talk about financial planning without looking at the sales of the business. Number two is expense outlay or expense projection of the business. Number three is statement of financial position. Number four is cash flow projection. Number five is break-even analysis to know when we're going to start making money. Number six is operations plan. How will the money be used in the day-to-day running of the business or working capital? Of course, we need to look at corporate finance. Corporate finance is a division of finance that is very important, and this division deals with how corporations deal with funding sources, capital structuring, and investment decisions. And corporate finance is primarily concerned with maximizing shareholder value through long-term and short-term financial planning and the implementation of various strategies that have been designed during board meetings, management meetings, and of course with the chief finance officer leading these sessions. And there are four areas of corporate finance which are important. Number one is operating flows. That is the actual flows of experience, the actual flows experienced by a company as a result of operations. That is the operations that are costing money to move. Either sales operations, purchase operations, acquisition of raw materials, this kind of operations. Number two is invested capital, particularly assets, fixed assets. Number three is cost of acquiring the capital. Number four is return on the invested capital. These four areas are critical in corporate finance. Sources of corporate finance include number one, retained earnings. Number two is debt capital, like loans. Number three is equity capital. Therefore, in conclusion, it is important to note that whether you're an entrepreneur, you're a senior executive, you have been in business for 10, 15, 20 years, it is important to note that having a deep understanding of how money works, of how finance works, it is key in business success. If you cannot do that for yourself, it's important to make sure that you have a high competent chief finance officer, accountant that can do this for you. Because if you miss out in finance, you miss out how finance works with your business, you wake up one day and discover that your business is dying silently. And the hard work you have put in for years and years will negatively affect the legacy you're trying to build as a business person. Thank you so much for following the session and keep building that business.